Let's hear what they're talking about on CNBC. Let's dive in here real quick.
We're live from Post 9 here at the New York Stock Exchange, and this make-or-break hour begins with wobbly stocks as another rate-fueled sell-off grips this market. It's doing it right now. Here's your scorecard with 60 minutes to go in regulation. We'll start with yields. That's what we're showing you now because that's where the pressure point really is. That's where it has been, and that's where it is yet again today. The 10-year, take a look, continuing its climb to fresh cycle highs, and thus it's hard to find many bright spots for stocks today. All three of the major averages under pressure throughout the session. Transports, utilities, once again sliding, although now I look and utilities are green. Not as if that's any consolation in the kind of market we're in anyway. No. And unlike yesterday when tech managed to rise despite the jump in yields, totally different story today. The NASDAQ getting absolutely slammed. Mega caps like Microsoft, Amazon, Nvidia are pulling back sharply. All of that, plus the congressional drama in D.C. We think that's taking a bit of a toll today as well. There's DC dysfunction on top of everything else. That takes us to our talk of the tape. How high will rates rise? And if they keep going up, can stocks handle the heat? It seems to be the only question that really matters at the moment, especially with earnings season still more than a week away. Well, let's ask our panel. Senior markets commentator Mike Santoli, Schwab's Kevin Gordon, and Malcolm Etheridge of CIC Wealth. It's good to have everybody here. Mike, I'll go to you first. So I got two things of green on my screen. The VIX at 20, a little north, and then utilities reversing to be positive. So that's not exactly a great sign for the market.
No, very faint bid. Also, Staples outperforming. So you finally see some of the traditional defensives responding to the kind of market conditions we are in. You have essentially the bond market searching.
That VIX spiking up there, folks. Yeah, things are getting a little intriguing. If we can hit 30, that would be ideal. If we can hit 30, man, we can see we'll see a nice flush on this market downward. Hedges will print money, and man, will it give some incredible buying opportunities. But yeah, VIX 30, that's ideal. But when we start talking about 20 plus, okay, now we're starting to heat up. The fear in the market. We're back into extreme fear territory as of today.
Negative going into October. So now we get an extra little flush and repricing of the market. I would say, even though you mentioned some of those mega cap stocks taking it kind of hard today. In general, it's not really concentrated anywhere. Equal weight, small cap, NASDAQ 100, S&P 500, they're all kind of in the general zone of just down, getting a haircut on this bond move.
Kevin Gordon, we might be talking about 5% on the 10-year faster than we thought we would, even after the rise that we've seen. Yeah. We're at 480. A little bit north of that as we speak. Mike, a lot of seasoned market watchers kind of weighing in on what they're seeing, and it doesn't seem to be all that difficult to understand, at least according to what they're talking about. Mohammed El-Arian tweeted earlier, last year markets were adjusting to higher rates, this year adjusting to rates staying higher for longer. It's like the Tepper commentary that we got last Friday. It is just a different environment, and no one really knows what the price should be relative to what the earnings are going to be. Yeah. The valuation of this market makes sense. It's the great unknown.
Well, because it's moving too fast, I mean, to Kevin's point, it's not just about, again, plug it into the equation and what does 4.8% on the 10-year get you in terms of paying for earnings. Right now, I think a not so terrible scenario would be that somehow the economy hangs in there. Earnings estimates on a forward-going basis for the next couple of quarters are not out of line with what we expect, and the market maybe can find its way. What I think is tough, though, is, and this has been the case for months, you're not going to liberate investors from the late cycle psychology, from this idea that it's when, not if, things buckle. Even if we go a year from now, we're still going to feel that way. And so
that's true. Good point. At the end of the day, it kind of feels like you just got to get it over with, right? You got to get it over with at some point in time, a potential recession. So let's hear what they're talking about here.
Like this to find what's high quality, what works really well, especially with an upcoming earnings season, and sort of benefit from any tailwind to the upside there.
Well, how do you view what's going to happen in earnings season? As I said to Malcolm, we're going to shift our attention, and we're going to be hyper-focused on the numbers, more so than maybe the numbers in the bond market at the moment. And is that enough to sort of save the day?
I think what's most important probably, and this plays off of what we started to see in the second quarter reporting season, where even though the earnings beat rate edged higher, and there was a lot of excitement over that. The reaction and from the market, even for companies that were beating estimates, was basically nothing. It was basically flat. So, you know, in our opinion, that had shifted the focus a lot more. That showed that the market shifted its focus to what was the revenue growth like, and revenue was most mostly flat, and if you adjust it for inflation, it was down for the third straight quarter. So from our view, you want to be much more focused on what the revenue mix.
Zoom's under $70. Interesting. Salesforce back under 200 there. Workday's been a pretty impressive stock. I've looked into them a bit. I'm impressed by Workday. Not a stock I own, but I am pretty impressed by what I see.
You have to start showing some kind of demand coming back too.
Mike, you always talk about what's going on under the surface, trying to dig a little deeper than the superficial.
Yeah, that man brought up a good point there. You got to see more than just cost-cutting measures being taken, right, in this market. You've got to see companies. You've got to really see companies, like, let's just call it this. You've got to see companies putting up revenue growth in these future quarters. It can't just be, oh, we cut employees or we cut expenses and things like that. You know, to continue to have this market kind of soar higher, we really need revenue to come around. So that's a big question mark for 2024.
Do you say, as a lot of people right now are saying, who felt too bearish when the S&P was making new highs and was up 30% off its lows, yeah, but it's not really as strong as it looks. And now I think there's a little bit of an instinct to declare victory. It's like, you see, I told you, stuff's really weak. Now they come up. But what do you do with it now? Do you say that the market has actually been pre-sold and a lot of valuation risk has been taken out? Or do you say...
All right, number of S&P stocks up on the year, 227. Stocks down, 271. So there's more stocks down in the S&P 500 this year than up. That's interesting.
You had this stealth bear market, and, you know, in 2019, when it was just like a handful of the NASDAQ stocks going up, and it was not always predictive of we're going down from here in the index. So we've had a little bit of a catch-down move from the large caps, and we'll see where it goes from here. In terms of the earnings season, we talked about it on Friday. 116 companies have pre-announced for the quarter in the S&P 500. So almost 1 in 4.
All right, so a little of the suspense.
So you got a little bit of a cheat sheet. The market's down 8% in 2 months. You know, the banks are down 15% since August. I don't think that the people are positioned for wonderful things for earnings.
Malcolm, so taking what Mike just said, what returns demand for stocks? What changes the narrative?
Yeah, well, two things. I think, one, we have to get past the sentiment of bad news means good news. I know the last few days the market has kind of trended in one direction, but I still think there's enough sentiment out there, listening to some of the voices on the network, where we feel like bad news means good news. And I think we have to get to a place where bad news just means bad news. We're willing to accept it as it is. And until that happens, which I do think is Q3 earnings, until that happens, we can't actually move forward to the point where it makes sense to start moving some chips back to the middle of the table. So I'm not arguing against anybody who thinks it's dry powder time. I think that's probably pretty smart here. But separately from that, we have to find out exactly what is going to happen in November.
Yeah, you got to keep some cash around, no doubt about that, at all times. In any market conditions, always got to keep some cash, especially when you can get 5% on your money right now.
And that no more, and we get the declaration that this is it? Or do we now have to be looking over our shoulder all the way into 2024, which I think the market just doesn't have the temperament to hold on and wait and see how that plays out. That could be if bad news equals more.
I'm sorry, what if you had a crystal ball and you said, okay, the Fed's done, I know they're done, and earnings are going to be better than I thought. Does that change your perception of whether you want to be engaged in the market right now or not?
It doesn't, because I think something else still has to break. It just doesn't make common, logical, mathematical sense for us to raise short-term interest rates more than 5% in about a year and nothing meaningfully break. So until we get to it, and I think that's probably on the horizon, right? It usually takes something like 18 to 24 months for interest rate increases to actually work themselves through the labor market. And that pretty much means by the end of this year, maybe we start to see an uptick in that unemployment number that we've been able to hang our hats on this whole time while we've been talking about fighting inflation. All of the responses have been, yeah, but the unemployment rate is at all-time lows.
Yeah, that's a really good point.
Well, I think that's probably going to finally change.
Oh my gosh, look at some of these stocks. Newell Brands down another 7%. Carnival is looking tasty, folks. Carnival's looking very tasty. $12 now. Carnival's looking very tasty, folks. You know, when it comes to CCL, okay? So the thing about CCL, they're always going to have a good amount of demand. And you just heard on their latest earnings, demand is really strong. So let me take a peek here. Let's see earnings estimates. Whoa, we'll come back to that in a second.
One of the reasons it's been a little bit different this time is because if you look at how we recovered from the pandemic, the bulk of spending and services and just the strength of that part of the economy, that was disproportionate relative to goods on a scale that we've really never seen. So when you talk about all the padding and think about all the padding that was in services, the fact that goods has gone through some form of a recession, but that really hasn't hit the broader economy, that to us remains the best case scenario, where you start to see rates take their bite, but it's in different pockets at different times, and that rolling nature of the recessionary behavior sort of keeps you afloat from a broad economic sense.
I'll tell you, Mike, what maybe is one of the most acute pain points within the market relative to the rise in rates, as we talk about the NASDAQ and the sell-off there, are those higher growth, less profitable stocks, which we just showed you some of them. I noticed on there. Datadog, I think you guys had up.
Yeah, we're going to come back to Carnival in a minute and talk about that one. I want to hear what they have to say about unprofitable.
Easy to see where the bulk of the pain within the growth spectrum is being felt.
Right. Look, when the market moves in a volatile way in this fashion, it's having to go farther to find people who have conviction. So it's hard enough to find people who have conviction about, is Johnson & Johnson going to make its numbers next year, as opposed to these companies that are kind of lightning in the bottle, maybe it'll work, profits down the road if we're lucky. That's not what's going to find buyers in a tape like this.
Great point. I mean, phenomenal point by him there, 100%. Not in an environment where you can get basically 5% guaranteed at the bank in a savings account. Well, it depends on what bank you're at. If you're at the big ones, you can't. But like Ally Bank, SoFi, Goldman Sachs, Marcus Product, many of those other ones, you can get 5% basically, or almost 5% a savings account. Treasuries are all yielding, the shorter term treasuries are all yielding 5% plus. So yeah, we are in a very competitive time for money, folks.
Seen as remarkable weakness under the surface of the market in 2021 into 2022, that's where a lot of the bubble activity was concentrated. It didn't really make its way over to the traditional market, which is, I think, one of the reasons that, the bear market for 2022, as, rough as it was, the rebound since then hasn't been, totally catastrophic. It hasn't been great. But I think that now you have to think, what is the effect of higher for longer and the Fed wanting to stick to that message? And if cost of capital stays relatively high, even if you go through the next easing cycle and the Fed pulls the Fed funds rate back to a range that's not zero, that's a very different environment than what you had, post-financial crisis all up until, 2020, 2021.
I was just looking at the banks, too, as you were talking, just because we flashed Goldman Sachs on the screen, which I think I saw down 4%, as that sector remains, that those stocks aren't doing well, down 3% in a week. All right, we'll leave it there. Kevin, thank you.
Thanks,
Malcolm, thanks. We'll see you soon. Mike, of course, coming back in our market zone as always. Let's get to our question of the day. Will the 10-year yield get above 5% before the end of the month? I mean, it's marching quickly towards that level. Again, 480 as we have this conversation today. Head to @CNBC Closing Bell on X to vote. The results are coming up a little later on in the hour. In the meantime, a check on some top stocks to watch as we head into the close. Christina Partsinevelos is back today with that. Christina.
What she got
here? Let's talk about Point Biopharma soaring as Eli Lilly announces plans to buy the cancer therapy developer for $12.50 a share in cash, or around $1.4 billion. You can see.
Doubt anybody owns that stock, but congrats to the few folks that do. Holy smokers, that's a move.
At about 2.5%. And a number of alternative energy stocks are sinking again today on concerns, yes, of the general economic picture, but more so the impact of what you were talking about, Scott, high rates on growth-focused companies. On the solar side, Array Technologies, Sunrun are among the biggest losers right now. You can see Array down 9%. You've got EV charging giant ChargePoint and fuel cell developer Bloom Energy also well over at least 5% lower right now. Scott?
All right. Christina, we'll talk to you in just a bit. Thank you, Christina Partsinevelos. We're just getting started here.
All right, so back to, I want to hear what else they were talking about.
NASDAQ dropping 2%. We break down the biggest moves and the health of that tech trade at large. Plus, one chart watcher says there could be greater decline still ahead. He makes his case coming up. We're live for the New York Stock Exchange.
Interesting. Okay. So this is a stock I'm looking at, right? And the stock's trading about 14 times 2024's expected numbers, right? And 10 times the following year. I mean, stock's starting to get really cheap. And the thing with Carnival that's a beautiful, beautiful, beautiful thing when it comes to this stock, folks, is is going to do well almost regardless of kind of what's going on. Let's see. Okay, there we go. I switched it up. When it comes to Carnival, if the economy is in a good place, certainly people are still going to take their cruises and do those sorts of things. If, let's say, money is tighter in that sort of economic environment, then you're still going to get a situation where Carnival is going to do very well because their cruises are very inexpensive, especially if you compare it versus like almost any other sort of trip you can take. I mean, it's all inclusive, and I mean many of their trips are $500 to like $1,500 on the higher end, and that's all inclusive. $500 to $1,500 is pretty darn affordable for a vacation compared to obviously many other options you have out there at your disposal, right? So I think that is a very interesting stock in this environment. It's getting killed because it has a high debt load, obviously, and we're a higher interest rate environment right now. But obviously we're not going to stay in this higher interest rate environment forever, more than likely, right? And if there's all these concerns about recession and what could happen in 24, the Fed will start cutting if we actually start to see some sort of detriment in the overall economy. Now, there's also potential we don't, right? And so that's something to kind of keep in mind. But then you can say, well, Carnival's business is going to stay strong, right? So yeah, that's an interesting stock. I almost look at it a little bit like Elf back in the day. Obviously, completely different business model. But when it comes to Carnival, if people are trading down, it's still going to do well. It's still going to do well.